Traders know that after a prolonged sell-off like we've had in 2022, there's inevitably a bounce, usually a very strong bounce that takes place in the market, and it can come very quickly and with no warning. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are trained to deploy powerful options trading strategies to profit, in some cases immensely, from situations like the inevitable market bounce that's coming. In today's video, we will be sharing with you a really simple strategy that can be deployed once the market bounces that can put you into a position where you can own call options for free if you manage the trade correctly. So if that sounds like something you'd like to learn, then stick around. This information could prove valuable to you sooner than you might think. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so everyone knows that the market has been beaten down pretty badly so far this year, with the S&P 500 represented by the SPX index now in correction territory, down over 13% from its highs, and tech stocks represented by the NASDAQ 100, also known as the NDX index, is now down nearly 20%, which would constitute a near bear market for tech stocks. And so what history tells us is that after sustained sell-offs like we're experiencing, the market eventually bounces, with one of the most dramatic recent examples, of course, being the COVID-19 sell-off, which took place in the first 3 months of 2020, followed by a dramatic recovery over the next 2 months, where at first the S&P 500 index actually lost 35% of its value and then rallied more than 40% off of its lows in less than 2.5 months. And so, as you can see, when the bounces come, they're usually really strong, and opportunities are all over the place to play that bounce if you understand a little bit about simple option strategies. Now, before we get into the details of this very simple strategy to take advantage of big rallies on individual stocks, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose the video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, so the example I'll be sharing with you, which incidentally is based very closely on a real trade by one of the traders on our desk. This example involves the trading of Tesla call options. So we need to make sure that everyone watching this video understands how call options work on stocks. And this is going to be quick, so for those of you who understand how call options work, just hang in there for a minute. Okay, so a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option, regardless of how high the price of the stock has gone when he exercises that right. So all other things being equal, when a stock price goes up, the price of a call option for that stock will go up, because obviously if you can buy shares of a stock that is getting more and more valuable for a fixed price, no matter how high that stock goes, then that right itself starts to get more and more valuable. And if a stock price goes down, again, all other things being equal, the value of the call option will obviously go down because that right gets less valuable. And if on the day that the option expires, the stock's closing price is below the price of that call option, then it loses all of its value, because no one is going to exercise their right to buy 100 shares of a stock at more than it's worth in the open market. Okay, so with that in mind, let's go back to October 27th of last year. And as you can see, Tesla had rallied sharply after a very strong earnings beat, pushing up from the 900 area where it was trading pre-earnings to over 1,000 and then up further into the 1050 area. And as I mentioned, this example that we're about to share with you is based on a real trade that one of our traders had made based on his belief that Tesla was going to have a secondary breakout, pushing it even higher over 1100. And so on that morning, if you had bought 3 of those 1150 calls expiring in 10 days when Tesla was trading at about 1068, you would have paid 1558, as you can see. So if we analyze the cash flow, we can see that the trader pays 1558 per call option. But remember, each option represents 100 shares of stock. So you multiply that cost by 100, and you bought 3 of them. And so the total initial cost of the trade is $4,674. Okay, so now let's move forward to November 1st. And as you can see, the trader was in fact correct. And Tesla had in fact taken a second leg up and had pushed through by the end of the day to over 1,200 for the first time ever. So let's say that in the afternoon on November 1st, the trader went ahead and this time sold 3 of the 1,200 calls, which were just above where the market was trading at that point. The trader would have received a price of $34.54 for each of those calls. Now, let's see where we are cash flow wise at this juncture of the trade. And as you can see, by selling those 3 1,200 calls, we brought in $10,362, as you can see from the calculation, using that same 100 share multiplier and recognizing that we bought 3 of them. And so the crucial thing to realize at this point is that we are now positive cash flow on the trade. Why? Because when we subtract out the original cost of the 3 1150 calls, as you can see, the premium we brought in for selling those 1,200 calls exceeded the cost of the 1150 original calls. That therefore makes us cash flow positive. Now, a little bit later, we're going to get into why that's so important. But in the meantime, let's move to the day that these options expire. And as you can see, Tesla closed that day at 1222, having stayed above 1,200 for a few days. And so on the day these options expire, we can determine the final value of each of the options. And the way you determine that is by figuring out how much each of these options is what options traders call in the money, which means how far the closing price of Tesla was above the strike price of the calls. So let's start with the 1150 calls that we own. And as you can see, if you subtract Tesla's closing price of 1222.09 from the 1150 call strike price, you're left with 72.09. And that's the value of each option, because assuming we exercise our option, we would buy the 1150 shares, which is the rate we had under those 1150 calls. But the shares are worth $72.09 a piece higher than that per share. So our account would immediately reflect a gain of $21,627 because our cost basis was $72.09 lower than the market value at the end of the day the options expired. But then remember, we also sold the 1,200 calls. And so assuming the call buyer of the 1,200s intended to acquire the Tesla shares and exercise his right to buy them at 1,200, then our account immediately takes a hit in value of $22.09 per share, because now we were the ones forced to sell them $22.09 below market. And so our account is marked down by $22.09 for the 3 calls we were short, which is reflected in the cash outflow of $66.27 that you can see on the calculation. And then finally, we need to add back in the $56.88 of positive cash flow that we received from selling those 1,200 calls for more than we bought the 1,500s for, resulting in an overall trade profit of $20,688. Now, before we wrap up, I want to point out something crucial that happened during this trade that you might have missed. You see, once we sold those 1,200 calls, which are located very significantly above the 1150 calls that we bought, once we were able to sell them for more than we paid for the 1150s, then at that very moment, we sucked all of the risk out of the trade. And at that point, we were guaranteed a profit. Why? Well, let's think about it. Let's suppose that instead of closing over 1,200, Tesla closed at 1150 or lower on expiration day. Well, at any price below 1150, both options expire worthless, right? There's no value to owning a right to buy shares of a stock at 1150 when it's trading at 1150 or lower, obviously. And there's certainly no value to an option up at 1200 when it's trading lower than 1150. And so both options expire worthless. But we still have that cash flow of 56.88, and so that's our minimum profit, right? Even if both options expire worthless, the absolute minimum we can make on the trade is that 56.88. And the reason is that once we sold those 1,200 calls, we no longer had negative cash flow on the trade. And so no matter how low Tesla had gone, we were guaranteed to make at least 56.88 once we went positive cash flow on the trade. And that's why this trader essentially put himself into a position where he had those 1150 calls, which had potential value if Tesla closes above 1150. But that right ultimately didn't cost him anything because he cleverly sold the 1,200 calls at a higher price than his original cost basis on the 1,500 calls, making the trade risk-free at that point. And this will always be true for any call stock option that you buy where you're later able to sell calls at a higher strike price than the ones you originally bought. So what I'd like you to take away from today's video is that once you buy a call option, if the stock rises as you expect, you may well have an opportunity to turn the trade into a risk-free positive cash flow trade by selling a call option at a strike price higher than the call you own, as long as you receive more for that call option that you're selling than the call option you originally bought. It's because our traders are trained to understand these kinds of option strategies where they can put themselves into positions to make an excellent profit on a trade while simultaneously guaranteeing profit on the position early on in the trade while leaving plenty of room for further trade profit if things go as anticipated. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.